Jim Lebenthal, you have some moves of your own that are quite interesting. I'm going to go to the buy first, and then we'll go to something that you trimmed, because the one that you bought is controversial, to say the least. It's New York Community Bancorp.
Yeah.
You bought this in your personal account.
Thank you for pointing that out.
Okay.
Yeah.
Tell us why you decided to do this.
Yeah, so first off, no clients are in this if you're listening, but also folks at home. What I'm saying to you is this is a speculative trade, all right? It is higher risk than the normal investments that you hear me make. Now, I do my normal rationalization on this, and many people have fallen for this siren song, but here's the analytical rationalization. They have, of course, they have some uninsured deposits, but they have cash and liquidity on hand that's about 160% of what those uninsured deposits are, so that if they went out the door, they have the liquidity to match that. They have equity that's equal to taking basically a 1/3 loss on their entire commercial real estate portfolio, which, apropos of what Josh was saying, is a little bit unrealistic. Now, people will say, of course, commercial real estate stinks and it's going to go down. It's not all going to go down that much. I think, though, the rationalization has to be held in balance against the speculative nature, which means a bank run could happen at any time. We saw that with First Republic a year ago. We rationalized that then. It didn't matter. So that's the element, folks at home. If you're listening to this, you have to go in eyes wide open. Here's a secret sauce, Scott, that really got me thinking about this. Number one, Steve Mnuchin's no dummy. I mean, let me leave it there. He just put $1 billion in, not him personally, but with a consortium of investors. And frankly, not only is he no dummy, but I think FDIC, Treasury, and the Fed knows that this bank has to survive so that future trouble in the banking system doesn't come home to roost on the Fed's balance sheet. What I mean by that is they can't let mergers like what New York Community Bank did a year ago go under, and they can't let white knights come in and get blown out, which is what they can't let Steve Mnuchin happen. So there's an ephemeral aspect on top of the rationalization, but folks, it's speculative.
Okay, so we have the highs of the day there. Does it bother you at all that stock, as I see it now, let's call it $3.50, looks to me to be below where it was when the news hit that Mr. Mnuchin and co. were coming in and doing what they did, and what that might suggest about the fundamentals of this business moving forward? So the stock obviously got a huge lift the moment that news broke, and it was a handful of days ago, and we were all sort of transfixed by what was happening there. But how would you address that?
Well, of course, this is something that somebody has to be uncomfortable if you're buying this stock, Scott. And again, that's why it's not for clients. What gives me a little bit of comfort is that it looks like the tangible book value is in the mid-6s, so you're buying something that's around 55% of tangible book value. And look, remember, before the Mnuchin deal hit, the stock was below $2 a share. So I'm going to have a tight stop. Well, not that tight.
You got to give this some $1.80, $1.86,
I think it was,
like
right? And then it popped up to the high 3s, and now it's back down a little bit. Remember, the warrants that they struck are struck at $2.50. The shares that they got are struck at $2. Mm-hmm. Look, it's not without risk. That's why I'm heavily qualifying this. I'm going to give myself to 270 as far as a stop, and if it hits that, I'm out, and I'm just not going to look back.
Josh?
So, Jim, I think one of the things that might be accounting for what Scott is bringing up, the fact that the stock is not higher than where it was since the rescue was announced, is probably something technical that maybe buyers like yourself could actually take advantage of. This is going to have to come out of a lot of indexes. This is, first of all, no longer a profitable company. It's probably not going to be a dividend story, at least anytime soon, nor will it be a shareholder buyback story, nor will it be a quality story. So all of that, all of those indices that are going to have to kick this thing out means a lot of fund managers and a lot of index funds are going to have to kick it out, which is probably where the selling is coming from. But if you're Jim, you don't have those restraints. And so you can get into something like, and I'm not in the stock, but you can get into this while other people are forced sellers. And that could be advantageous in a world where index funds are so influential. Do you guys agree with that?
Well, you know, one thing I'll say, Josh, is maybe the reason it's up today is certainly not because I'm buying it, but because they are doing a reverse split, which the idea of which is to get it over that $5 threshold, which for a lot of institutional managers is that floor. So that speaks to that. But yeah, what you're saying, this is no longer a dividend aristocrat. I mean, I'm saying that a little bit tongue in cheek, but yeah, there are going to be some forced sellers here.
So the other area of the market, which I think has gotten the most scrutiny of late, and deservedly so, is the chip space. For the magnitude in which a lot of these names have gone up, and not just NVIDIA. We've gone down the list almost every day, you know? Supermicro, AMD, blah, blah, blah. And you mentioned you're a little uncomfortable with some of the exposure you have in that space. So you trimmed NXP. Tell me why.
So first off, it's a sector call, and I was way too overweight. I said this on air yesterday. I'm 14% chips and chip equipment in my portfolio. That's simply too much. So I'm bringing it down to 12%, which I think all of the other investors here will say that's still pretty high. But you got to trim your winners along the way. NXP has just been a very solid performer for 4 years, and it has 50% of its business tied to automotive, which I've got a great exposure in GM. So that's the obvious candidate as far as where to trim. You know, Qualcomm's had a heck of a run too, but I think there's more legs there. It may step back a little bit before going forward, but NXP, just because of that duplicative aspect with GM, was the obvious candidate to trim.